If you don't have private health insurance, you're at risk of a massive tax bill. The Aussie government works really hard to try to make us take up private health insurance in order to take the pressure off the public health system. And the main way they do that is through what's called the Medicare Levy Surcharge. If you're confused, let's break it down. Firstly, what is the Medicare Levy Surcharge, or MLS as it's often known? Well, if you earn above a certain income and you don't have private hospital insurance, the MLS is an extra tax that you'll pay at tax time, somewhere between 1 and 1.5% of your entire income. So, for example, if you earn $100,000, then you will be paying an extra 1% tax, which is a nice clean $1,000. Now, this is different to the Medicare levy, which is a tax that every single person who pays tax pays. Now, the MLS is on top of that. It is a surcharge. Okay, so who pays the MLS? Well, there are some thresholds, and you'll start paying the tax if your income goes over the first threshold. For individuals, that's $97,000 a year, and for couples, it's $194,000 a year. That is, of course, assuming you don't have private hospital cover. But here's the thing, it's not just your regular income that counts. The Australian Tax Office uses a unique definition of income for MLS purposes. You might think, well, I'm under the threshold. I don't earn $97,000. But the ATO is using some extra numbers in there. Most importantly, they're also counting superannuation, and that includes the mandatory superannuation that your employer pays, which is currently an 11.5% additional payment. And that's where thousands of Aussies get caught out every single year. They don't take hospital cover out because they think they're under the threshold, and suddenly they're over the threshold. Let's talk through some numbers to get a little bit of clarity on this. Okay, so the first threshold of the MLS is $97,000. Well, let's say you earn $90,000. Okay, you're under the threshold, you haven't got hospital cover, you figure you don't need it. But once you include the 11.5% superannuation contribution that your employer has made, you're suddenly blowing six figures for MLS purposes, which means you're going to be up for the tax, and that tax is going to be over $1,000. The closer you get to $97,000, the worse that's going to be. If you're earning $95,000, once you include super, the MLS tax at the end of the year is going to be about $1,080. Alongside super, the ATO will also include any fringe benefits that you get from your employer. Now, this isn't a huge issue for us, but if you've got a company car, or you're on a visa sponsored by your employer, or you've got any other perks, they could be added by the payroll team at your job. And that means you're just closer and closer and closer to the MLS without even knowing it. Now, the way to avoid this is simple. You just got to take out private hospital insurance. An eligible hospital policy will exempt you from the MLS altogether, and you can often find a policy for less than the MLS would cost you. Let's say you're earning $98,000 a year for MLS purposes, so after super, and you will be getting a MLS tax of $980 at the end of the year. Now, let's say you find a basic policy that costs you $1,000 a year. There are a few of them around. Now, that about levels out. In either case, you'll be out of pocket $1,000 or so, but at least if you take out hospital cover, you'll have something to show for it. Of course, the exact numbers will vary for you and your circumstances, so you'll have to check out the details yourself. For example, hospital cover comes in 4 different tiers: basic, bronze, silver, and gold. And bronze gives you a lot more coverage for just a little bit more than basic. So a bronze policy might be $1,100 a year, so you're paying a touch more than you would the MLS, but you're getting quite a decent policy as a result. That's why you'll have to make the decision for yourself. Head to Finder to find out a little bit more about how to do it. Don't wait until the last minute. Just taking out a policy just before the end of the financial year doesn't wipe out your liability for the entire year. You'll owe the MLS for every part of the year that you didn't have cover. So if you take out hospital policy one day before the end of the financial year, it will only be 1/365th of the MLS that you'll be avoiding. The best thing you can do is to get covered now, at whatever point in the financial year it happens to be. That way, you can avoid the MLS and keep some hard-earned dollars in your back pocket. You can find more information and find a policy that's great for you at finder.com.au, where you can compare from 40 or more providers in minutes. Click the link in the description to learn more, and I'll talk to you next time.